Hello, and welcome to the latest episode of the Later Life Lending podcast. I'm delighted that Stuart and I are joined today by Colin Bell from Perenna. So, first of all, hello, Colin.
Morning, how are you doing? It's great to be on this podcast.
Oh, it's really good to have you on, actually, Colin. And Stu, how are you?
I'm all right. Yeah, very good. It's a bit cold today in chilly Lytham, but it's good to be here.
Yeah, a bit cold everywhere, isn't it? But I think today it'd be really good to find out a little bit about Colin and where you came from and how you founded Perenna, but also I know Stu's got a lot of questions about Perenna itself because, as we said before we started recording, it's lovely to see a new face and a new business in the later life market. How's that been for you, Colin?
Yeah, it is great. I've worked in financial services my whole career really. So interesting enough, I started as a broker as an IFA quite a long time ago. I have some years on me now. But moved into lending kind of 10 years into my career when I set up Interbay from scratch for a US firm, which is now quite a well regarded and large specialist lender in commercial bridging, buy to let, etc. But really, that it's during that time that I met the two co-founders because we were working on warehouse funding and securitization back in 2006, 2007, so 20 years ago. And we've always kept in touch. And actually, interestingly, Arian, one of the co-founders, is Dutch, and he's always had this view that why is the UK mortgage market uh, always pinned to short-term fixed rate mortgages, typically twos and fives. Why are there age restrictions? Why do we not cater for customers all the way through life, like they do in Europe? And so he's always wanted to create a different style of bank in the UK. And that's why we came together. We came together to set up a new bank, three of us, three founders, to change the way mortgages are done, to create a new structure of bank where we're not led by deposits. We're not funded by deposits in the same way as everyone else is. The problem with deposits is they're short term, and therefore mortgages are therefore short term. So because you have an interest rate risk, if you have a short term deposit and you try and do a long term fixed rate mortgage, there's interest rate risk, which the regulators don't like because it creates instability. So our mission was to create a bank that's funded through covered bonds, through the issuance of covered bonds, like many countries in Europe, from Denmark, Netherlands, Germany, and actually not dissimilar to the US market. And that allows you to do long-term fixed rate mortgages. Now, long-term fixed rate mortgages are great later in life because actually your income is stable and probably doesn't change. Taking variable products when you're older, for example, is probably not the best advice, whereas having it fixed for the whole term with flexibility can be. So we embarked on a project to set up a bank. It did take us good 5 to 6 years to fully get our banking license on our exit. It's difficult to get a banking license, but we persevered. Regulators actually really like what we're doing, but it's hard to get a license. So it should be hard to get a license as well. There's a lot you have to do before you get your license. So we stuck at it, worked our way through it, and got our banking license a year and a half ago, our full banking license, and went live at the beginning of last year with our product. So that's my kind of journey. Always worked in lending.
Yeah.
Uh, but also being an IFA. So I actually see both sides of the fence. Didn't just do mortgages, also did, other products. So I kind of both sides. So.
Wow. So that was the shortest podcast we've ever had. Thank you very much for joining us. That was the whistle stop tour. So let me take you back then. So you started as a broker. Was that your John Charcoal days?
So slightly before that, I initially started as a self-employed IFA. Went through my FPC exams for a short period of time, and then I was approached by someone from, I'm trying to recall now, but it was someone from a life company saying that John Charcoal were looking for people, looking to expand. They're quite small at the time. This is in the 90s. And I was asked if I would go to Knightsbridge and become a mortgage broker in Knightsbridge, which I did. So I took that opportunity, and that was my first employed job as such. So back in the early days when John Charcoal was very small, there weren't many of us there. Some of the names that were there are still around now, which is great. But yeah, that was my first kind of foray into more of a corporate environment, but also
Name names. Who was there with you? Who would we know?
Ray Bolger. So Ray Bolger, who's
Right.
obviously
Yeah.
a lot
Yeah.
in the press. So yeah, it was that kind of era. John of John Charcoal was there then. There was a chap called John Garfield. So that was the John from the John Charcoal. So, but there are a number of other people who were around in the industry who were advisors at the time. Julian Ingle, who's at Corico, for example, was the one I worked very closely with because we moved to Guildford to open the Guildford office back in the day. So, yeah, a few examples there.
Wow. Oh no, that's really good then. So that sounds very glamorous to me, being a mortgage advisor in Knightsbridge. It visions of very, very expensive property and large mortgages. Was that the reality?
I mean, yes, at the time we had two offices in London. We had Holborn and we had Knightsbridge, and Knightsbridge did kind of tend to deal with the more high net worth. But in those days, I mean, you're talking, 30 odd years ago, properties weren't at the price they are today. Yes, they were in that kind of area, they were expensive, but they weren't certainly at the levels they are today. I didn't stay there for particularly long because actually at the time, John Charcoal wanted to expand, and I was asked to go down with Julian to Guildford to set up a Guildford office. Again, a fairly decent affluent area, trying to hit the commuter belt into the city, and that's what I did. We went down there, moved into sales management, and then moved back to London when I took on a kind of group role as head of operations. I'd kind of suggested a kind of divergence of mortgage advice and IFA type advice at the time when you didn't need to be MCOB qualified, to be a mortgage advisor. So yeah, so I moved into operations, became head of operations and strategy, and kind of moved through the career. I was there for almost 10 years.
Yeah, no, great. Well, it's really good for us to know about your advice background, because I think that does give you a lot of credibility within the advisor market when they, hear you speaking and hear about Perenna, which we'll come on to. So how did the transition happen from that to the big banks, so Hampshire Trust and you setting up Interbay? I wasn't aware of that. So yeah, tell us a bit about that.
Yeah, the Interbay story was an interesting one because Interbay in the US is owned by a firm called Bayview. And Interbay itself was their lending arm in small balance commercial lending in the US and Canada. They were the largest small balance commercial lender over there. They were looking to expand into Europe because actually they used to issue or sell a lot of their bonds on their securitizations in the European market. And naturally, the UK would be a similar market for them to move into. But the interesting point was they didn't want to recruit people who'd lent before. They wanted to recruit people who knew the industry and were more on the advisory side. And their reason for this is that they wanted to teach those people who they took on their way of lending. They didn't want legacy. They didn't want preconceived ideas. They wanted people who were basically fresh in that regard. So I was recruited to set up the infrastructure of Interbay as well as the operational side, and very quickly moved into the CEO position of Interbay. So that was in 2006. Little did we know what was coming in 2007, 2008 with the credit crisis. But so we were merrily lending away, doing very well for ourselves. And obviously the credit crisis came along. Now, for Bayview and Interbay in the US, clearly their focus was on retrenching over there. And what they said is, can you achieve an exit for us in the UK? Which I did. I managed to sell the business to a PE firm. And whilst we stopped lending, the book actually performed really well, and we carried on managing the book whilst we were waiting for the credit crisis, kind of post credit crisis, to settle down. And the book performed very well. And we retained good people so that we could return to lending. Ultimately, we then moved on to ownership, sold the business into JC Flowers when they were buying Kent Reliance. And creating One Savings Bank. So at the same time as creating One Savings Bank, they bought Interbay and also bought Kent Reliance, and that formed One Savings Bank. And the Interbay brand stays stayed as Interbay and still is there today. And I stayed on again for almost 10 years, running distribution and products across all of their brands, so including Kent Reliance and they're a second child lender.
Yeah, wow. Fantastic. Yeah, you seem to get itchy feet at 9 years, 11 months with
Yes.
jobs. I don't, what is this? Can't do 10 years. What is that?
I think, some people move around a lot. I consider myself that I
Yes.
didn't. 10-year stints is quite good. So it's yeah, it's approaches really, and it's I think we'd got certainly at Interbay and at One Savings Bank, I'd got to a position where things were good, things were going well, and actually the kind of buzz of setting up new things and creating new things, that's perhaps what I'd look for again. So uh, and that's what I did. So yeah, I wouldn't say it's a 10-year thing that I particularly think about it, but it just happened to have been that way. So it's quite interesting. So let's see another 10 years here, and let's see, shall we?
Yeah, absolutely. Or actually, you've been there 7 years, 6 months, I believe, looking at your profile. So, yeah, 2.5 years. Look out. So, next challenge. So tell us a bit about the Perenna challenge. Then I know Stu's got lots of questions about that.
Yeah, the parent challenge is interesting. Obviously, setting up a new bank is tough. As I said earlier, it should be tough as well. Getting a banking license is really important. It's not easy to do. There's a lot of oversight. There's a lot you have to go through, and so there should be. Maybe we didn't expect it to take quite so long, but we went through the COVID period as well, so there's a lot going on. But also, the regulators needed to understand our structure. We don't take deposits in the same way everyone else does to fund their mortgages, and so they had to understand, where our risks are, where our controls are, what we're doing. Product wise, they got it. They get the concept of fixed rates. Obviously, we're a fixed rate led mortgage market anyway. We just happen to do longer ones with flexibility. So it was always we were leaning into a positive environment with the regulators, but you know becoming a bank should be quite an intrusive process, and it is. So, and I have to say, it was really enjoyable getting to the point of gaining a banking license. It was great fun. It was hard work, lots of ups and downs, lots of challenges. Learn a lot for sure. But we've got great people around us, which we've built up through time, and that's why we are where we are. So, and then we launched, like I say, formally January last year into the market. So.
Mm. And just building on from that, Alex, I guess I suppose I probably first became aware of the Perenna brand maybe about a year ago, something like that. And more recently, it seems as though certainly within the later life lending market, that presence is accelerating. I've noticed turning up to the big industry events, which is great, because it's great to have new people and new voices and new ideas. And we'll come on to that in a bit, but just taking us back to that sort of launch period and getting grounded in the UK market, just for anyone that's perhaps a little bit unfamiliar with Perenna. So what we've talked, yes, long-term fixed rates, but just expand on that a little bit, if you could, in terms of what's the core Perenna proposition when we're talking long-term. What are we talking about here?
Yeah, you're right. We did launch last year, and the thing about being a bank is that you have, capital constraints. You have the regulators want you to grow in an orderly fashion as well, and so do we. So we have to be quite controlled. And the challenge with the mortgage market is it's a massive market. 30, 40 billion a month of mortgages when you include product transfers, huge market. As a bank, we have to stay capitalized as well. So you can only lend so much against your capital, and you're constantly raising capital. So it's very difficult to launch in an orderly manner, but I think we achieved that. Our view was really that, and certainly my view was, there's two main demographics in a higher interest rate environment, which we were then and still are now, that would really appeal to our style of lending. Firstly, it's first-time buyers, because if your mortgage is fixed for the whole term, you don't have to stress for interest rate risk. Lenders nowadays have to stress in case your mortgage goes up by 1, 2, 3, 4, 5%. So a lot of lenders are stressing it 7, 8, 9, 10%. So yeah, you can afford it at 4, but can you afford it at 8 or 9? And it's that constrains their borrowing. Well, we don't have an SVR. Mortgages, whatever term you choose between 10 and 40 years, it's fixed for the whole term. The ERCs, the early redemption charges, are only 5 years, but the rate is fixed. So we don't have an SVR. We don't have to stress. So theoretically, for quite a number of people, you can lend them a bit more money because the pay rate is the stress rate. So that appeals in the first time buyer market where people are trying to get on the ladder. And obviously we do terms of up to 40 years, and a lot of first time buyers actually, interestingly, will be in the retirement age by the time their mortgage finishes, which is interesting. So the second demographic as well is they're called later life borrowers. I don't like to call them later life. Two reasons. One, I don't think it is later life because you're kind of only really halfway through your adult life at 50. And secondly, because I'm in that bracket, so I don't consider it later life. I consider it midlife, right? But anyway, people aged 50 and over and in retirement and beyond, they're not very well served. Most lenders want their mortgage to finish before they get to retirement or on retirement. A lot of lenders are not comfortable lending into retirement, and a lot of lenders can't do long-term fixes. And you don't really want rate shocks when you're 65, 70, 80, 85, because your income, you can't really change your income. So we have no max age, and we have this fixed for life concept, and therefore we're bringing a new product into the later life lending arena, into the older population, that provides an alternative to equity release, for example. So equity release works for some people. They want the interest to roll up. They want that flexibility. Their income may not be there to service a full loan. So you go equity release, for example. But some people actually just want a traditional mortgage, but they want it over a longer term. Some lenders will only lend to 70. So people were saying, being told your mortgage is only 10 years. And at 10 years on a repayment, guess what? You can't afford it. We'll do 40 years. We'll do interest only. We'll do Rio. We'll do, which is retirement interest only. So, and we'll do capital and interest as well all the way through. So what we realized very quickly is that market is actually going to be a good market for us. We thought it would be, but we could see it was happening. I think our third mortgage that we did was to a 72-year-old on a 40-year repayment. So, very quickly, people were cottoning on. Actually, there is a market for this product in the older age brackets. So we provide great stability in that market, and like I say, we have no max age. We are affordability led. You have to be able to afford the mortgage in retirement, but we do allow things like sale of property. We do allow people to use that as a concept. We do look at both incomes, so we take joint income, because we know people will make adjustments if in retirement if things happen. So we want to be flexible. We're bringing a new product concept. And hopefully what we'll see is advisors who are in the later life sector or the equity release sector, for example, can now consider different products at the same time. Equity release is right for some people. This will be right for others. And that's kind of what we want to do, which is why we're coming to a lot of the trade events that the equity release advisors or the later life lenders are at, because we feel we've got something to bring to that market.
Yeah, that's great. I mean, in our market, in the what is termed the later life lending market, which in itself is a move forward from what was the equity release market, which was a tiny village in a big city, and now becoming a bigger part of that city of mortgage lending. The move to a more holistic approach to lending to borrowers has been primed, if you like, in the last couple of years around the issue of affordability. So the move towards presenting more options to customers, including full servicing of interest or partial servicing of interest. We've seen new products launched, like the new payment term lifetime mortgages or the hybrid models that have come in. So that's all great, but it's also, I suppose, presenting a bit of a dilemma to existing advisors who have been very used to a very particular type of approach to advice for later life borrowers. So what are the kind of challenges that Perenna have faced in that market? As you attended these trade shows, you're starting to talk to later life equity release advisors. What's been the reaction to the Perenna brand and proposition, and what are the challenges that you're kind of still facing into?
Yeah, it's interesting because I think you're right. In terms of the market for later life lending, actually the advice has been a bit siloed. People are equity release advisors and only advise on those products. And then there are non-equity release advisors who can't advise on equity release products anyway because they're not qualified to do so. And therefore, as a customer, you come in and you're not seeing someone who's necessarily looking across the market. I think that's changing, and I certainly saw that at the recent conference that we were all at. That actually people are realizing now you've got to look across the different product types. Actually, these other products that operate in what was traditionally equity release lending markets actually are good. They have a place. They're not for everyone, but they have a place, and they're starting to look at them. One of the challenges that we again realized before we went live, and I already had this in my mind because, as I said earlier, I was a mortgage advisor in the past and an IFA, is the mortgages are paid on a transactional basis as well to the advisors. You're paid typically up front once, and you don't get paid again unless you change that mortgage. Now, that's not really great for the later life market, where actually sometimes it's better to stay with the mortgage you've got, but also you have to do this review. And as an advisor, you're not necessarily getting paid for that review unless you're charging fees. And it's quite tough to charge a fee for a mortgage review when the customer may not feel they want one at that point. So we quickly realized that we need to pay up front in the normal way, because a lot of the effort when you first write the first mortgage is higher effort, and you're doing what you're finding, you're getting to know the customer, you've acquired the customer and spent the money acquiring them. But also we should pay through the life and treat this a bit more like a life contract, a bit like the pension contracts, investment contracts, that kind of thing, where you're actually paid through the life as well. So when you get to the review point at, let's say, year 4 or something like that, if it's right to keep the mortgage where it is, you'll get paid. If it's right to move it, you'll get paid. And if it's right to do a product transfer with us, again, you'll get paid. So kind of trying to take the bias out of the advice, but also respecting the fact that you're providing a service to your customers through the life of this product, and therefore you should be remunerated through the life of the product. And that was really important to us. Now, not many people necessarily know we do that until we speak to them. And sometimes longer term fixed rate products were seen as a threat to the business models of advisors. And that's important. Advisors need to survive. If advisors don't survive, customers don't have good advice, right? So it's important that we help build these businesses, provide annuity income to brokers as well, and it also encourages them to do reviews, which are important. Customers' needs change. They might have other products they need. Things may be fine. They might not need a change, but you just get paid through the life. So it wasn't a challenge, because we came to market with that concept. The challenge is people remembering that we do that, remembering we have no max age, remembering we'll do C&I, capital and interest, or interest only, or REO, right the way through to whatever age. We have no concerns about it, because most lenders don't operate in that way. When you've got 50, 60, 70 other lenders operating differently, people remembering, Perenna do things differently, can be a challenge. So, but I think we're getting there. When I go to these events, so many people say, "Yeah, I've heard about you." And they typically will pick on one or two of our USPs, depending on what market they're in. Yes, I know you for this. I know you for affordability. You lend more. I know you for no max age. We've got to try and get all of our USPs out there so that people remember us, and that's a challenge when you're new to market.
And just staying on that theme of challenge, it feels like the Perenna is quite a destructive brand in a good way. So it's good to be a disruptor in a market. You're bringing long-term fixed rates, as you say, is something that's not familiar to the UK market, or certainly from a residential perspective.
We're taking what we consider to be a great concept from other markets. In markets where long-term fixed rate mortgages do exist, they're the product of choice, actually, because people don't want to take interest rate risk on their biggest debt. Typically, their mortgage is their largest debt. Now, for 7-8 years post-credit crisis, rates were extremely low and didn't really move, and people kind of forgot that rates can go up and down. And when they did go up, they went up very quickly, and a lot of people got caught short. And again, this is another disruption with our product, is that if you take a 2 or a 5-year fixed rate mortgage, for example, you actually don't have flexibility. You're always in an early redemption charge, and you're always pegged to a certain date that you have to remortgage by that date. Otherwise you end up on an SVR. Is that date right for you? Is the market right for you? Are rates high? Are you still working? Are you between jobs? Has something changed? We do a lot of cases later in life for people who are getting divorced later in life, and all of a sudden their income has reduced. They can't get a mortgage. They want to stay in their home. One of my colleagues calls it, I think there's a phrase now, I don't know if it's wide or whether it's our phrase, silver splitters. It's happening a lot. And therefore, if you go short, you could be in those situations at the wrong time, and then you're stuck. You're stuck on SVR. You're stuck where you can't stay in your home because actually the mortgage is no longer deemed to be affordable on a traditional mortgage. Um, with our concept, the 5-year ERCs means after 5 years, you have control and flexibility as a customer, and the advisor has that control as well. You can change your mortgage at any time without, without an early redemption charge, at the time that's best for you. So at a time when maybe rates are lower, you take another long-term fix, and you probably keep that for the rest of your life, right? So you can pick and choose your moment, but at least you know for the moment your premium won't change, your monthly cost won't change, and you can budget for that. So it is quite disruptive, but it's very positive disruption. It's great for consumers, great to give them choice. And some people will always want to chase the lowest rates and go 2 and 5 year fix and ride that cycle, and that's absolutely fine as long as they understand the risks of that. So.
I just want that's a really good segue into my last question about in terms of the Perenna proposition. You described it, you mentioned it earlier. We're in a high rate environment now, so a challenging environment for a lending market. But it feels to me as though all the way through, Perenna has kind of faced into all sorts of challenges. It took you 5 or 6 years to get your banking license, as you said. All of that was done during COVID. You've emerged with a brand new, certainly very unfamiliar proposition into an established market, right at the time when rates have started to shoot up. So it kind of almost feels like some would say, "Oh my God, it's almost the worst time to launch a new proposition." But it feels as though Perenna's kind of embracing that. So, are you kind of? Do you feel bullish about the opportunities? Because there are some people that have been through that very low rate environment and are kind of looking at the high rates now, saying, "Crikey, it's really challenging, really difficult to speak to customers about higher rates, lower LTVs." Are you quite bullish about the future opportunities in this market then?
Definitely bullish about it. I mean, if you can make it work in a high interest rate environment, you can definitely make it work in a low interest rate environment. It's for us, bizarrely, it was better for us to launch in a higher interest rate environment. I think, as I said right at the beginning of our chat, that as a bank, you have to hold capital against what you're lending. You have to be careful how much you lend against the capital you have. What you'd never want to be doing is stop starting, right? So launching in a very low interest rate environment probably would have caused a lot of problems for us. And we probably would have had to push our rates up, to stem demand, and that's not great for an advisor to see rates going up and down all the time. So you want a bit of stability there. So things will only get better for this concept as rates reduce. If you can buy a long-term fixed rate mortgage at the bottom of the market, it's kind of gold plated. And again, what we also do, which is interesting and very interesting in the later life market, is that if you need to raise money in the future, because sometimes you do to pay for care as your bills rise, for example, you can keep raising more money on new products and add it onto your mortgage, or you can remortgage the whole thing if it's in a better situation. But if you've got a kind of gold plated, really decent mortgage, and you can just kind of add new lending on top with different terms, different repayment vehicles, and obviously it will be at different rates depending on what's in the market at the time. So that's again another area of which lends itself to the market that you operate in. So, but yeah, it's launching a lender is challenging always because you're breaking into a market that actually is pretty well served. The area we've moved into, we don't see it as being well served, and I think we had a big opportunity there. Our challenge is more getting people to remember this concept exists and penetrating a market that's typically operates in a different way in the UK compared to Europe. So.
That's really interesting. Colin, we've come to the end of our time, but I feel like I need to do another podcast to find out more because I've got so many questions. How do you feel if we launch this to our listeners, get their questions about specifics, and we do another one in a couple of months that is more specific questions about, I'm thinking products, about your zero bills mortgage, about your calculator, your featured brokers on your website, how to source you, how to compare you to other products. I've got so many questions, but I want to get this out to advisors and then them to start their questions as well. Are you okay to reconvene in a couple of months?
Definitely up for that. As you said earlier, we've got a lot of information on our website as well. And just one thing for your listeners as well, our calculators on our website, both on our consumer website and on our intermediary website, they are using the same affordability engine that we use when we underwrite. So if that's the answer you get, as long as everything you've put in comes true, the affordability, for example, it's a great calculator to play with to see how much people can borrow. But yeah, it's using the same decision engines that we use. So, but yeah, I'd love to answer questions. New concepts always raise a lot of questions, and we love spending time answering questions.
Well, let's put a date in the diary for that. So, Colin Bell, thank you ever so much for your time.
Thank you both. It's been great.